On July 4th, 2025, President Donald Trump signed the One Big Beautiful Bill Act into law. This law touches just about every aspect of American life, including healthcare, government assistance, border security, national defense, and, of course, taxes. In this video, I explore the effect the One Big Beautiful Bill Act will have on ordinary taxpayers and how you can prepare for the changes coming ahead. I'm the Tax Geek, and here is the One Big Beautiful Bill Act, or OBBBA, oversimplified. This is an enormous act, and the dozens of individual provisions regarding taxes need to be interpreted by the IRS and turned into regulations and new or revised tax forms. I am attempting to present as much basic information on the Act as I have been able to obtain from multiple sources in the days after the Act's enactment into law. As additional information becomes available, I will produce updates through the year. Major sections of the Act will get their own dedicated videos before the end of the year. Several existing videos on the channel will have update notes in the video's description and in pinned comments. This video only focuses on the tax provisions of the OBBBA. Discussing the spending implications of the Act is well beyond the scope of this channel. My goal is to educate and inform and assist you in making decisions that will result in the lowest tax liability. Of course, your questions and comments are always welcome in the comment space below. First of all, the OBBBA extends most of the provisions of the Tax Cuts and Jobs Act that were scheduled to expire at the end of this year, making a number of those provisions permanent. Most notably, it extends the existing individual and corporate tax rates already in place. Also holding over from the Tax Cuts and Jobs Act are the Qualified Business Income Deduction, the higher standard deductions and elimination of personal exemptions, and limitations on the deductibility of expenses such as moving expenses and unreimbursed employee business expenses. Now let's look at some of the provisions of the OBBBA that are new and not extensions of the Tax Cuts and Jobs Act. A big impact to many taxpayers will be the No Taxes on Tips or Overtime provision of the OBBBA, which takes effect in 2026. This allows customarily tipped employees to deduct up to $25,000 in tip income from their taxable incomes. And employees receiving overtime pay may deduct up to $12,500 in overtime pay from their taxable incomes. The important thing to remember is that the provision applies to federal income taxes only. Tips and overtime will still be subject to Social Security and Medicare taxes, and may also be subject to state and local income taxes. As such, all requirements for reporting tips remain in place. These deductions are subject to a phase-out for taxpayers with adjusted gross incomes above $150,000. The overtime provision applies to all employees, but the deduction for tips will be limited to a list of occupations where tips are customary. This list is expected to be published by October 31st, 2025. Next, we have the additional standard deduction for seniors. This provision is in effect for tax years 2025 through 2028. There will be a new $6,000 deduction for each taxpayer or spouse age 65 or over, in addition to the increased standard deduction already in place. Here are some examples. For a single taxpayer, age 67, you start with the regular standard deduction of $15,000, then add the existing additional standard deduction for single taxpayers age 65 or over of $2,000. To that, you add the new additional standard deduction of $6,000, resulting in a total standard deduction of $23,000. For a married couple filing jointly, with both spouses over age 65, you start with the base standard deduction of $30,000. Under the existing law, each spouse is entitled to an additional standard deduction of $1,600 or $3,200 total. And then you finally add two of the new additional standard deductions of $6,000 or $12,000. The result is a $45,200 standard deduction. This deduction starts to phase out at AGIs over $75,000 for single taxpayers and $150,000 for married couples filing jointly. The Inflation Reduction Act introduced new credits for purchasing electric vehicles, as well as installing clean energy sources, such as solar panels on your home, or making energy-saving improvements to your home. These credits will be eliminated. The Clean Vehicle Credit will expire on September 30th, 2025, and the Residential Energy Credits will expire on December 31st, 2025. If you purchase an electric vehicle before September 30th, you should be able to transfer your credit to the dealer if the dealer agrees. Since the residential energy credits are based on when the improvements are installed, as long as the improvements are installed by December 31st, you should be able to claim the credits, even if the improvements are not yet paid for. Next, there is the increased child tax credit effective 2026. Under this provision, the child tax credit will be increased to $2,200 starting in 2026 and indexed for inflation in future years. Up to $1,000 of the credit will be refundable as long as the taxpayer has earned income. AGI phase-outs remain the same as the previous law. Other new deductions include a vehicle interest deduction, which is effective from 2025 through 2028. Purchases of new vehicles that are assembled in the United States will be able to deduct up to $10,000 in interest on loans used to purchase them. This will show up on tax returns as an adjustment to income and won't require a taxpayer to itemize deductions. This is also subject to AGI limitations starting at AGIs above $100,000. And while we're talking about deductions, we need to mention the increased state and local tax, also known as SALT Deduction limitation, which will be in effect from 2025 through 2029. Taxpayers may now deduct up to $40,000 per return in state and local taxes, or $20,000 if married filing separately. This maximum will increase by 1% per year from 2026 through 2029. This deduction will also be subject to AGI limitations, starting with AGIs over $500,000. Here are some miscellaneous tax-related provisions of the OBBBA. Taxpayers will be able to deduct up to $1,000 in charitable contributions, even if they don't itemize. And bonus depreciation has been permanently raised to 100% for property placed in service after January 19, 2025. These are just a small part of the changes brought about by the OBBBA. More detailed videos will be produced on most of these provisions before the end of the year. Links to the full text of the OBBBA, a summary of its contents, and additional resources and information can be found in the video description. If you found this video informative, please give it a like and subscribe to the channel for more oversimplifications of our increasingly overcomplicated tax system. And as I said earlier, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.